Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be going through certain details of how financial statements are prepared, what do you mean by financial accounting, the meaning, objectives and importance of financial accounting when it comes to accountancy course. Let's go ahead and find out that thing. So when we talk about financial accounting, we talk about a specific journey, a journey which starts from the 7-step process. That means identification, measurement, classifying, recording transactions, summarizing them, and then further going ahead with analysis, interpretation, and communication to the users. So when we talk about any of these information, that means this specific process is followed from end to end so that all the users can have all the specific information related to investment that will help them guide or probably go ahead with any business making decisions. If they have to deal with the specific business or if they have to go ahead and further choose some different options will completely depend on the kind of information that has been provided. So when we talk about providing information, it has to be flawless. There cannot be any kind of errors, because if at all there are any errors found out at a later stage, it will be kind of misrepresenting those details and kind of forging those details, which will further lead the specific image of that company to be drowned further. Now, when we talk about providing information, we further go ahead as to how these informations are provided, what kind of information is exactly required, why a financial accounting is the major or the core subject when we talk about any kind of accountancy firm. So when we talk about accountancy firm, one firm further is managed by a managing director, an MD, or probably a group of directors who further go ahead, follow that 7-step process, and after that they create the journal, they create the ledger, they create the trial balance, which is further used for preparation of profit and loss account, trading account, and balance sheet. Once this balance sheet is prepared, you further go ahead with this specific balance sheet to be communicated to both our internal and external users. So once this journey is done, what happens is this information will help all the required stakeholders to go ahead and make a decision as to which specific investment has to be made in which category, whether they have to invest in this specific company, whether their returns will be high, whether there will be guaranteed returns or not. All these decisions are made by the specific reports that are provided. Basically, trading account, profit and loss account, balance sheet. These three things define the financial position and the structure of the company. It also includes the performance that they're giving, whether it's a satisfying performance, whether it's an odd performance, whether the performance is completely excellent. So basis on these things, they will further go ahead and invest or probably make some business with the company or the firm, and then this will actually help the firm's image to grow if the returns are good, if the specific reports are specifically good. Hence all these things are critical and very important when it comes to financial accounting. So once this journey is completed, we'll further go ahead and understand how important is financial accounting, what details does it comprise of, what all things are mentioned in it, how a specific term can be different from other specific terms which has been mentioned, what are the differences, what are the specific terms that has been mentioned, technical terms it may be, accounting terms, what exactly it has will be mentioned in here. Let's go ahead with the journey and find out each and every detail of financial accounting. So when we talk about financial accounting, we'll describe in this video the meaning, objective and importance of how financial accounting is so correlated, and the existence of financial accounting is the base of any accounting firm when it comes to communicating to the users, because the users won't go ahead and look into your books, but they will look into these reports which are mere important for you but very very important for all these users, because this is the face of your company when it comes to financial transactions. When the financial face of the company has to be represented, these specific reports will be the first representative of your company. So let's go ahead and understand who requires these details. The first part will be the stakeholders. Now, any firm which has been developed or which has been established, they go ahead with preparing these details. The first core reason why they prepare these details is to record these transactions. Once these transactions are recorded, they further go ahead and store those things so that there can be absolute control, monitoring, and tracking of all the performance, all the issues, and all the way outs that we can follow. So when we talk about performance, the performance of the company relates to in terms of financial numbers, how the performance of the company is when it comes to growth, how the performance of the company is when it comes to profit, whether it is suffering loss. If it is suffering loss, what is the kind of percentage it is suffering? How many losses can the company actually bear? Is there any chances where the company can recover those losses? Any bad debts that has happened? Is there any chance where the provisions can be increased? How the capital can be increased? How the profit can be increased, etc. All these things are really important because this will actually show the financial position, the true and fair view of the position and performance of the company. So when we talk about the true and fair view of the performance of the company, this is what we'll be dealing with. After this, once the start is done, we go through the closure procedure. The closure procedure is preparation of financial statements, basically trading account, which includes all the trading stuff. That means the raw stock things, anything which is related to factory expenses. So the production thing is already mentioned in the trading account. When it comes to office and expenses, it comes into profit and loss account, which is the next step after trading account. Both these things help us make the balance sheet because all the items which are recorded in your balance sheet are a part of trading and profit and loss account itself. So these three things, basically these three statements, actually show how your business is. It is the first face-to-face representative of your company on papers. So when you talk about preparation of financial statements, three statements to be prepared: simple, easy, and quite local to understand. The first one will be trading account, second one will be profit and loss, and the third one will be balance sheet. Now, when you share these information, who actually is interested in knowing this information? The first person has been mentioned down here. Let's go ahead and check that part. The stakeholders information requirement. Now, what do you mean by stakeholder? Any person who is interested in your business and has invested certain amount in your business is the stakeholder. Is the person who holds certain amount of your company or is actually interested in the growth of your company, because that growth will lead to his growth further. That amount which he has invested in your company, and if he has track record of all these informations that he requires to ensure that whatever he has invested in your company is going to give him high returns at the end of the period, or his money is secured and there is no loss, that's when these specific informations prove a boon for him, and that further leads to any kind of capital funding that is required in near future. So in near future, if required any kind of capital funding, this will be actually provided by these people: the investors, the suppliers, whether they give you on credit or cash. It completely depends on this thing. Let's take, for example, the credit score that is required when it comes to preparation of or taking loans from banks or financial institution. If you have a good credit score which is about 750, it becomes very easy for you when it comes to taking loans from the bank. The approval is quick, the documentation is very less, and within like few days, 2 or 3, you get the loan account, or probably the loan account is actually credited with that specific amount. When the credit score is low, that means they know that the performance of your salary and your financial statements, or probably your financial background, is quite not that good. Hence, when we talk about these things, one, a CIBIL score is the reflection of how your financial prepared is, or how your financial preparation is when it comes to any kind of taking loans or funding. So as you as an individual who require financial help, and the CIBIL score is the financial status or probably the representative of yours, same way for a company, these specific statements act like a CIBIL score. If the statements are good, true, fair, and view, that means this will lead them in getting more capital, more funding from the investors, from the suppliers, because they know that you have the potential to give their money back, to repay their money back on time with high returns. The same way any bank has trust in any individual when it comes to giving out loans to them, because the job of the bank is to give out loans, but They cannot have a lot of defaulters. The same way, any supplier, any investor will look after these details to make sure that whatever they're investing, they get their money back with returns. And the same way, you have that capital to expand your business. Now, when we talk about these things, any stakeholder information is supposed to be shared by the users. Now, internal users, maybe like the people who are handling this specific company, will prepare these details and then further share it with the internal users first. Once they approve it, then it goes to the external users, because they need to make sure that all these details are absolutely flawless and there are no manipulation in it. Once this has been done, the external users go ahead, analyze them, interpret them, and further go ahead with the investment. So when we talk about users, now that we have already known that these things are supposed to be shared to the users, internal, external, both. Internal maybe some of the VPs or presidents or probably any person who is in the panel of board, who further goes ahead with preparation of policies which are good for the company, who further goes ahead with the existing policies revamp which is required every now and then depending on the kind of situation the market is in. So if the market is good and if there is certain boost that is required, we will further go ahead with changing the policies. Different products may be launched, or anything that can be done in terms of enlarging the business or empowering a lot of power here when we talk about expansion of business. On the contrary, when we talk about external users, they require these details so that they know where they're investing, whether that will specifically lead them to high returns which are being claimed by the company, and if these things are actually true and fair. Hence, we have auditors who will further go ahead and check the validity of all these reports, whether these reports are actually considerable or something that we can call as true and fair view of the company, whether these reports they actually give that thing or not. So these users will be further classified into the number of names that I've mentioned down here. Let's go ahead and check it one by one. Now, when we talk about internal users, we actually talk about the current owners of the company. We talk about the managers of the company, someone who is in charge of this business, someone who is taking care of this business. The person who is taking care of the business is the owner, someone who is in charge of this business, that is the manager. Now, the manager goes ahead and reports to the owner all these details which are required in terms of making policies. Now, when we talk about the external users, there are three categories or three people who we have mentioned down here. Let's go ahead and check. Government, prospective owner, and bank. These three people are external users who are very keen in knowing the balance sheet details, in knowing the profit and loss account, in knowing the trading account. Because when it comes to government, it wants to know whether you're paying that much of tax on it, whether the profit earned is actually the earned profit or whether you're just faking it out. Prospective owner, anyone who wants to invest in your company, anyone who wants to buy shares of your company, will also be keen interested in knowing what the balance sheet shows, whether the asset side is strong, whether the liability side is too strong, better than asset side, whether the liabilities are too more, or probably if the liabilities are very less as compared to asset. This will probably help him to make decisions on his own, and then further the investment will be made as per his requirement or as per his judgment. After that, the banks, because the banks are the most crucial part when it comes to any financial accounting firm. Now, when we talk about banks, banks are the only institution who give out cash to you, who give out capital funding when you need a lot of funds for investment at a cheaper rate. So when we take a loan from bank, we need to have a lot of documentations done. This specific documentation is required so that the bank is assured that whatever amount is being given to them, they have the capacity to repay that back with the interest that has been charged to them. On the contrary, if the business proposal is good, that will actually help the company to grow and flourish in the nature where the income flourishes and there is a lot of company income that will help any kind of EMIs or any kind of liability to be paid off without any hassle. Hence, these users are the internal and external users when we talk about. Let's go ahead further and understand what are the details are mentioned in terms of financial accounting. Now we'll learn about distinction between capital and revenue. What is capital? What is revenue? Now, both they actually term to be like something which is related to income. We have already learned that capital is something that is invested into the business by the owner out of his own money. Capital will also include certain categories like reserves and surplus, which includes a part of profit and loss. Something which will also include that the capital which has been taken as a form of loan, that is in terms of shares, preference shares, debentures. Now, capital is something that actually shows how much cash the company has, how much account or liquidity it has, rather. Liquidity would be the right word to describe capital. How much liquidity it has when it comes to instant cash funding. So, this will include the shareholders' fund, how many shares the company has issued, and depending on that will be the authorized capital that we have. We have different types of capital which we'll be studying further in this specific chapter itself. After these capitals, we have reserves and surplus, the profit, the reserves that we have created. We must have learned about these in the earlier lectures. So the reserves, the surplus that are created for this will be something that has been already mentioned. On the contrary, revenue. Revenue is something which is something that you have earned because of the operating profit, operating and non-operating profit. Now, when we talk about operating profit, it leads to revenue, but non-operating profit leads to gain. You already know the distinction between revenue and gain. So revenue is something which is earned because of the regular business activities that you do. For example, if you have a car showroom and if you sell out any car, the income that you have or the amount that you generate because of selling that car is the revenue. However, if you have a car showroom and if you have a different plot or spare plot that is with you, which was ideally used for garages or keeping the spare car there, if that has been sold out and that made you earn certain profit, that is known as a gain, because that is not your business. Your land selling is not your business. Had it been your business, that would have been an operating profit. But now your car showroom and selling out cars is your primary business. Hence, anything that is required for that purpose or anything because of which you earn out of that specific operating activity can be termed as revenue. On the other hand, capital expenses are there, capital income is there. Revenue expenses and revenue income are also a part or distinction that we can study further in this chapter. This is the core definition of capital and revenue. Let's go ahead further and understand what are the details are available in this chapter. So when we talk about expenditure, we'll further go ahead and classify what expenditure is, what are the types of expenditure that we have. Now, expenditure actually means the expense that you do when it comes to enlarging your business, or it may be of recurring and non-recurring nature. Expense is something which is done when it comes to preparation or making the business run or expanding the business. Two categories. First, for the regular expenses, that means the regular inflow and outflow that is required of items and the expense that you make for them, that is one expense. Second, an expense that is made to enhance the current organization or to enhance the current operation. So the regular operation activities for which we make the expenses, and second is to enhance the current operation activities. For example, let's take an example, the car showroom that we had. Earlier, we had a car showroom which was just like one single floor. On the other hand, we found out there are a lot of inquiries, there are a lot of customers that are coming in, and it was pretty much difficult to accommodate these many customers at one single point of time. So what we did is we enhanced the flow. We further took it to another level. That means we made a duplex, one on the lower floor, the other on the second floor, and we had that many staff. So what we did is we made certain expenses. We ensured that this specific showroom looks specific or great, and we have a lot more people inside to help the customers that are coming in on a frequent basis. This is an expense. However, there are two categories here. One, that is an operating expense. Second, that is a non-operating expense. One that is a recurring, second that is a non-recurring. Now the expansion that has been done is a non-recurring. We don't do expansion every day. We do it sometimes. We do it once in a year. We do it once in 2 years. However, when it comes to recurring expenses, we do it every now and then. Supposingly, the rent that is paid for the actual plot that is there, that is the recurring expense that has to be paid, because that is something that you will earn the benefit, or the probable income that you earn, or the probable benefits that you earn because of the plot is every month. Hence the payment that you have to make is every month. That is something that is recurring. That's an expense again. So expenses are of different types. First is a capital expense, which is of non-recurring nature. Next is a revenue expense, which is of recurring nature. So capital is something which enhances. Revenue is something which is needed for the regular operations. So for example, if you have any kind of rent payment that is done, that is a recurring expense. However, if you have any kind of expense whereby you have enhanced the showroom quality, you have enhanced or you have taken another plot for expansion of the showroom, that is something which is known as a capital expenditure. So these are two kind of expenses. The same thing when we talk about revenue, these are the two kind of revenues that we have: capital revenue and a specific revenue when we talk about a non-recurring revenue and a recurring revenue. So revenue, basically we have only one category: income and gain. So talk about revenue, we'll have income, which is from the regular operating activities, and gain, which is from the non-operating activities. Let's take the same example. If you sell out a car out of the showroom, that is your revenue income. However, if you sell out the land which was adjoining to that specific showroom, which was owned by you, now that is a gain. Hence, that is a non-business activity, non-operating activity. That's the reason there's a gain, or that is specifically called as income. Revenue is nothing but this is an income. Income can be earned in two ways. One, that is from operating activities. Second, that will be from non-operating activities. So from operating activities, you have any income, that is a revenue. However, if from non-operating activities, you have any kind of income, that is gain. So I hope this is pretty clear for you when it comes to expenses, when it comes to revenue. Expenses will be of capital and revenue nature. However, revenue or income will be of non-operating and operating income. That means revenue and gain. So when we talk about any kind of expenses and income, or if there is a short note on this, you can define it in this way. Now, when we talk about any such details, revenues, capital, expenses, any income, there is one more category that we need to discuss about. That is the deferred revenue expenses. Now, these kind of expenses are something that we call as a one-time expense. However, the benefit earned for that specific expense is for a lot number of years. Let's take an example. You have opened up a new showroom and you have done heavy advertising for that specific showroom. Now, this actual expense which has been preferred or which has been done will be calculated or will be actually written off for number of years. You cannot just write down that specific. Or let's take an example, if you have maintained or if you have done somewhere around 2 lakhs to 3 lakh of expense on advertising itself, you cannot just write down 3 lakh expenses, because that will cut down your profit to a higher margin and there will be low profit in the first year itself. But if the 3 lakh expenses can be cut down in 5 years, so you have even distribution there, and that specific expense is termed as deferred revenue expenditure. So when we talk about deferred revenue expenditure, this is how one kind of expenditure for the benefits which can be earned or which can be actually enjoyed for a lot many years, rather than the one where you spend that specific amount and the benefit is earned only for a specific period of time. So that is the difference between deferred revenue expenditure and revenue expenditure. I hope this was pretty clear for you. Now, let's go ahead further and discuss few more terms about what all details we have when it comes to financial accounting. Financial statements. The first more core important reason or the objective of financial statement is to give the true and fair view. True and fair view. Anything that is related to account should not be manipulated. It should be giving out true and fair view of any picture. So the picture that is shown to our audience, or rather we can call them users, that is something which is supposed to be completely error free. It cannot be misleading, it cannot be manipulated, because that will further lead to a lot of complications for any firm, any organization, as this specific firm or organization has been taking money from people for their expansion. And if at a later stage they understand that this was forged or this was all fake, in that case the company's image or the goodwill will be hampered a lot, and the company will fall into a lot of legal complications where the bankruptcy will be one of the effect. And the second thing, the company will be banned, it will be completely out of the business, and there will be no possible chance of that reviving chance or the reviving factor for that specific company. So when we talk about true and fair view, this is what you need to understand. Now what do we talk about true and fair view? What exactly true and fair view is related to? That means performance and position. So when we talk about performance and position, that means we talk about the company's performance, we talk about the company's position, what exactly the performance leads to, how the company has been performing for so many years, whether there is a specific trend. So if you have seen a cardiologist heartbeat, that means a specific trend that we follow. That specific trend helps you or gives out details about how that specific person is actually behaving when it comes to his health. The same way the company's health is tracked by its performance, whether the performance is satisfying, is excellent, or under par or below par. So these specific reports will actually define. So these are the cardiologist thing which actually shows how the company's performance is. So when we talk about performance, it should be in such a way that is pleasing for the investor, to ensure that his money will be invested in the right place and he will be giving out returns which will help both the customer in getting higher returns and the owner of the company in managing his cash flow and expanding his own business. When we talk about performance, this is what you'll be knowing about. When we talk about the position means not the company status, it means what the statement shows. It means whether that specific statement is showing out the true value of the company. This is what will be shown in the position of the statement. So two things, performance and position, will be the core important factor when it comes to preparation of financial statement, that is giving out true and fair view of both these things. Let's talk about certain things that we have to understand when it comes to preparation of financial statements. Let's go ahead further. Now, to start with preparation of financial accounts, we have already understood how trial balance is prepared, how ledger and journal balances or entries are made. So when we talk about preparation of trading account, preparation of profit and loss account and balance sheet, these are the three core important things that we need to understand, which are the details which are supposed to be sent out to the stakeholders, investors, suppliers, and anyone who is keenly interested in investing in your business. So when we talk about trading account, now, as you know, trading account is already related to something that we know or is supposed to be required to be captured with details which are related to your factory, or expenses, incomes which are related to your factory expenses or manufacturing things. So when we talk about trading account, it always relates to stock materials or raw materials, stock, purchases, anything that is related to procurement of goods. So when we talk about the first stage of preparing anything, that is related to trading account. Hence, we talk about trading account and manufacturing account. This is something that we'll be learning further when we further go ahead with preparation of trial balance, preparation of manufacturing account, profit and loss account, balance sheet. Now, after this, you further go ahead with preparation of profit and loss account. This will always help you in differentiating how trading account is different from profit and loss account, because this thing will consist of details about office expenses. So imagine you have a factory, you have an office related to the same factory. Any expenses, income that has been made and has been earned in this specific thing or office related items will be recorded in profit and loss account. On the contrary, if any expense has been made for procurement of specific goods or items which are related to production of that specific good, or the actual final good that we sell out to our customers, that is coming under the part of factory expenses, and hence it's a part of trading account or manufacturing account. This is mainly prepared by the wholesaler, retailers who are actually preparing these things so that they can have a complete detail of how much inventory they have, what are the purchases, what are the wages, what are the expenses that has been made, how many sales has been made, what is the gross profit, and further that specific thing is transferred to profit and loss account, which will further give you the true picture of the net profit that you have and is a part of balance sheet. under the part of capital and reserves and surplus. Now, after these two things are prepared, the content of these two things will be a part of balance sheet. So when we talk about balance sheet, we have liability side on the left, we have asset side on the right. This thing will show that what is the true statement or the true and fair view of that specific statement, rather the true and fair view, that means the performance and position of the company, because this liability and this asset side will actually show or depict how the company is performing. So when we want to track the record or the performance of that specific company, you actually need to see these two things. Is the liability side more than the asset side, or rather, if we already know that the balance sheet already has a total of liability side and asset side which should be equalized. But when we talk about liabilities and asset balance, we need to check how much liabilities does the company actually have, because liability includes capital, reserves, and also certain things that you need to pay back. Now reserves, if the company has a lot of reserve and that's the reason the liability side is strong, that means the company is performing really good. But if the company has less of reserves and more of loans that are supposed to be paid out, in such a case, this thing shows that the company is in a lot of debts. So if the company is a lot of debts already, in such scenario, it will be very wrong for the company or any person to show out that the company is doing good, and this will lead to misrepresentation or misleading to any kind of investors. So if these things are manipulated, this shows a wrong picture of the company and doesn't depict a true and fair view of its performance and position. So that's the reason an auditor goes ahead and verifies all these details with the subsidiary books of accounts that are shown to him, to check and to validate or to cross verify whether these details are actually matching the records that are being supposed to be communicated to the users. Hence, when we talk about any kind of balance sheet preparation, these are the core things that you need to understand. I hope this is something that you need to be pretty clear about. So we'll go ahead with certain format preparation. There are certain things that you need to know about: how to prepare a specific statement, trading account, financial account, or how to prepare a balance sheet. We'll just go ahead with a certain gist of it, and then we can close this thing. Let's go ahead further and understand what part we need to understand about it. We'll first talk about cost of goods sold and gross profit and net profit items. Now, cost of goods sold, the amount or the amount of goods, the quantity of goods that you are selling out to your users or your customers bears certain cost. That means the manufacturing cost. To prepare those goods, there is certain cost that has been incurred, and that cost has to be recovered. Now, for example, if preparing any item, you have incurred rupees 10. What will happen if you sell out that item at rupees 10 itself? There will be no profit. You will land up selling out the same product at the cost of goods or the production cost which it was procured for. Now, if this is the case, there is no profit here. Now, when we talk about cost of goods sold, we are actually talking about production cost. So how much amount you have incurred in preparing that good will be the cost of goods sold. After that, you add profit into it. That means that is the actual amount of sale price that you need to sell the customers. So if the profit amount is rupees 2 per item, that means you need to sell that specific product at rupees 12. That will fetch you profit, and that was something that you need to understand. That will help you in showing the profit side on the higher part. So the amount of rupees 10 is the revenue. However, if you add 2 rupees more to it, that means that is the total revenue including the profit part. After this, we talk about gross profit, we talk about net profit. The profit that is shown in trading account is the gross profit, something which is not related to or which doesn't include operating expenses. Now, after you deduct operating expenses and operating incomes as added to it, that means this amount or the profit and loss that is shown is either net profit or net loss. So if you have gross profit, if you add certain operating incomes, or rather if you add office items to it, office incomes, any income which is shown in the profit and loss account is added to it, and any expense which is shown in the profit and loss account is subtracted from it. If the net amount is positive, that means that specific thing is the net profit. If the net amount is negative, that is net loss. So this is something you will understand when we'll practically go ahead with preparation of these statements, and that's when you will be able to understand how this specific thing is interrelated to each other, and how these statements, that means trading account, profit and loss account, and balance sheet, are actually interlinked. Preparation of one thing will lead to preparation of another, and eventually the preparation of balance sheet will be the closure of this specific sum. So once this is prepared, you need to go further and analyze how you can interlink these things. Let's go ahead and understand the last two parts of it. Operating profit, that means earnings before income tax. EBIT is the short form. Earning before income tax. Any earning that has been a part of this specific chapter before income tax. That means if the tax has not been deducted, that is the operating profit. After that, once the tax is deducted, that is the profit which has been earned after deducting income tax from it. That means the liability which is supposed to be paid to the government has been cleared off, and that is the divisible profit which can further go ahead and can be shared as a part of dividend, and apportionment can be done into that. That means it can be further shared into reserves and surplus, it can be further dividend or provided to dividend users, or it can be further shared as a part of bonus, or we can further go ahead and put down bonus in forms of profit. Now once this is done, we'll further go ahead with the preparation of balance sheet. Balance sheet will include a specific format. I'll explain you how that format works. I'll give you the details, I'll give you the total format of it, and then after that is prepared, we'll actually understand how the process, that means preparation of trading account, is interrelated to trial balance things, and how this specific thing is actually going through a specific sequence. That means preparation of trial balance, then further preparation of trading account, profit and loss account, and balance sheet. So this is what you know, or what you have to know about financial accountancy or financial statements. Now when you talk about financial statements, make sure there is no mistake in any kind of numerical errors. If you have any numerical errors, it will lead to preparation of a wrong balance sheet, and if that happens, it will be a time consuming process for you to actually go ahead and rectify these details, further to fetch that detail first, or to fetch that error first and then rectify it, because it will be an in-depth analysis that you have to do when it comes to preparation of balance sheet. That means if there is any error that you have done in the preparation of trial balance, so you have to change that error right from that step and further go ahead and improvise the balance sheet ahead. Hence, make sure all these details are captured as per the amount they have been mentioned, and all the accounting treatments are given actually according to the rules and regulations are supposed to be followed. So this is what we need to understand when it comes to meaning, objective, and importance of preparation of trial balance or preparation of financial statements into accountancy. Thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.